Welcome to Subramani. Last year, which means 2022, has been a year in the US where inflation hit a all-time high. I would say over a 40-year period. I mean, people like us who have been old enough to be watching the American markets, 1981-82, rate of interest would be about 18%. I've seen 18% kind of 17-18% kind of return on bonds. 10-year bonds, and we saw it fall right up to 1%, right? So 18 to 1 was a 40-year one-way street. I mean, it may have had small ups and downs, but largely the broad trend was the interest rates came down. So the time when interest rates hit an all-time low, obviously bond tips also suffered, that is inflation protected bonds also suffered. Every asset class suffered, which is the classic case of saying when interest rates go up, asset prices fall. So obviously all asset prices fell. The S&P index fell by about 18%, but everything else other than perhaps gold did not fall that much, but your REITs, your real estate, your bonds, everything fell, and everything fell perhaps a little worse than equity. So there was really no place to hide. In a very well proportioned asset allocated portfolio also you saw a pretty damaging portfolio, and you had to be ready for it, right? This kind of falls would happen once in maybe once in 10 years, once in 5 years. These kind of falls are quite common. So what has happened in the US, it's a well researched market and a market with a lot of products. So there is a sensitivity, price sensitivity, or rather inflation sensitivity equity index. They pick up shares which are sensitive to inflation, which means when inflation goes up, these shares will do well. Right, fairly obvious, something like defensive, something like energy, right? People don't have too much of a choice. Companies with a large free cash flow, company with paying rising dividends, so you're sure that some part of the money comes back as dividends, so you're less sensitive to the price change. Right, so companies which are not just energy but could be consumer items, industrial consumables. In India it could even include industrials, because they have not gone up much, and the private sector capex is likely to happen. So some of these so this is the first trust Bloomberg equity sensitive, inflation sensitive fund, which will obviously take some kind of a concentrated risk in these industries which I mentioned. And the interesting part is one will have to see how it performs, because I think this is the first time somebody is coming, but Bloomberg actually has a equity sensitivity index. So equity inflation sensitivity index. So when inflation is high, what kind of shares would go, which would go up, right? So when there is a lot of free cash flow and the dividends have been rising, fairly obvious that something like a Coal India should do well. Anything which is paying out high dividends should be doing well, because people are hoping for higher dividends. Obviously companies with debt should be doing badly, so these companies they would not invest in. Obviously it's an index which is available, so for them they have to just copy paste the index on their portfolio, because they're going to track the index. So I think it's a very interesting theme, and so obviously you will have to worry about little about liquidity also, because there will be some kind of a concentration risk. All of that is going to be equally weighted, so they are not taking too much of a chance with which industry to add and which industry to reduce. So typically all are dividend paying check, free cash flow, and typically saying, okay, when inflation is high, some sectors will do well, and on that there will be concentration risk. So if something happens like an SVB, don't be in a hurry to take your money out, stay on for the long term. And fairly obvious, look at, just use common sense. What are the shares which could do well? It has to be fairly obvious that if the interest rates remain high, which means inflation remains high, your real estate may make a comeback. I'm not even recommending real estate, but real estate is likely to do well when equity market, when the inflation rates are high. equity market itself is likely to do well. Then of course you have energy, you have industrials, you have industrial consumables, regular consumables. Your maybe at least in India, FMCG has always been overpriced, so I don't think anything great is going to happen. But when there is inflation, people tend to cut down a little bit on even on FMCG costs, but not much. Right, but yeah, any discretionary, taking holidays, vacations, that might come down. So your Mahindra Holiday Resorts or Indian hotels, East India hotels, Thomas Cook may not be doing very well. So you have to do your mix and match. So, but I like the concept of this fund, and sadly, I don't see any Indian AMC launching any fund like this. I don't even think we will get the SEBI permission within enough time to. I would happily launch a fund like this, but if you do not know where to go, I think your dividend yield fund should do well. SBI has launched one recently, but I think every fund house has a dividend yield fund. One thing terrible about dividend yield funds, which is a problem for me, because a lot of my friends are retiring, they call up and say, I think this dividend yield fund is good. No, for me, when I retire, I can get dividends from here. That's not the way how a dividend yield fund works. It is just in like any other regular fund. When it says dividend yield, it just means what kind of shares will they pick up. You should not take a dividend yield fund and opt for dividend option saying, oh, I will do very well. No, it's a fund which you should not take dividends. You should anyway be in. If you want to invest, I'm not recommending any fund, but if in case you want to invest, you keep investing and start withdrawing as systematic withdrawal after it does well, right? So after it does well means could be 3 years, 5 years also, but after 1 year, at least the dividends are, the systematic withdrawal is tax free. So if you, let's say, put in 1 lakh and then it has become 3 lakhs over 2, 3 years, 4 years, whatever, then you say, okay, I will withdraw maybe 2,000 rupees a month from this, or 3,000 rupees a month for this perpetually. That is the way you should deal with it. Anyway, that I am digressing. But yes, when there is inflation, looking at dividend yield companies is good, but many people will not look at dividend yield companies simply because they'll say, oh, but what, why should I invest in 4% or 5% dividend yield when I can get 7% in a bank deposit? That's one way of looking at it. The other way of looking at it is saying, it's okay if it 3-4% yield is what the portfolio is getting, and I'm on a growth option, so I will withdraw only after 3-4 years. So instead of getting it as dividend, I'm converting it into a capital gain. So that can be another way of looking at it. So depending on whatever is your view, see how inflation is going to impact, because I don't think interest rates are coming down in a hurry in India. Maybe in the US because of the banking crisis it might come, but in India interest rate may not go up, but I don't see it coming down in a hurry. So that's my view. Thank you.